Hello, good afternoon, good evening to everybody that's just joining us. I was just telling somebody else earlier, I am out in California, which is why it's still sunny out here. It's only 6 p.m. my time. I would love to see where you guys are at, so drop in the chat where you guys are dialing in from. And today, our goal is to cover everything that you could want to know about an IUL. So I definitely want there to be some Q&A. If you guys have been looking into IUL policies and you have questions or you're not sure, you've seen a video and you don't know what this means. Is this true or is that true? Like, that's kind of the whole goal today, is to answer any of your questions, but two, just really walk you guys through like things to look at when either you're designing an IUL, so either you're an agent and you want to learn more, or you are looking to purchase one. What does that actually look like? So I'm just going to start by explaining basically what an IUL policy is. I would assume you probably know what it is if you're on this live, but an IUL, it's a permanent life insurance policy where the client can overfund the cost of that monthly premium, and the money that they're putting in excess of what it costs will spill over into a cash value bucket that they can access at any time they want in the future in the form of a loan, all tax-free. Great to see that you're in Canada. I will definitely say that IUL policies are not yet available in Canada. You guys do whole life policies in Canada, but it gives you kind of the same exact features. Some of the vocab's a little different between IULs and whole life, but it's like same but different is probably the best way I can say that. So, and then hello everybody that's saying hi, great to see you. What was I gonna say there? Okay, perfect. So what we're going to talk about today is how to properly structure an IUL to meet different goals. So there's a lot of different ways that you can use this policy, right? There's basically, honestly, 4 different ways that you can structure it. You can structure an IUL to grow cash value for retirement. We call it tax-free retirement. You can structure it for what we call infinite or family banking, which is quick access, immediate access to cash right out of that policy. You can structure it for just permanent life insurance. That is an easy way to do it. And you can also structure it for college planning. So if you guys have kids or anybody with kids, they can make fantastic policy for children, because this is money that they can access for anything that they want to do in the future. So I'm going to kind of dive in here. I'm going to show you guys some numbers and kind of what to look at when you're designing one of these policies. Let me grab you and flip my screen and kind of show you guys a little bit about how these plans basically work. Let me move my laptop over here. Sorry if I'm making you guys dizzy, but this little box here, hopefully you guys can see this. This little box here kind of tells us everything that we could want to know about our policy. So I just drew this up. This is just an example of an IUL for a male, a healthy non-smoker looking for $500,000 in life insurance. And these are some of the features that you're going to see that come from that. So just so that you guys know, the amount of life insurance that you get, we call it face amount. I know, doesn't that just make it more confusing? So face amount is the same thing as life insurance. And if you look over here, this little summary of values, this is basically going to tell us everything that we could need to know about the policy. So sorry, moving you guys around, trying to get you in a good view. Okay, perfect. So here, what you're going to notice is based on that $500,000 death benefit, all of these numbers get configured. So if your goal is to grow cash value with an IUL, you ideally want to eventually be putting in like the maximum amount of money per year that you can based on the size of that death benefit. So all these numbers are controlled by the death benefit. If we increase the death benefit or face amount, all of these numbers will go up. If we decrease the death benefit or the face amount, all of these numbers will go down. So that dictates everything. So for example, minimum premium, right? That's the minimum amount of minimum amount of premium or cost or money that you have to put into this policy per year, annual premium, to keep it afloat so that the policy doesn't ever lapse or close out on you. So that's an important number to know. And then I would say probably your next most important number to take a look at is this number, your target premium. The best way I explain this to the client is like, if your goal is to grow cash value, you always want to be putting in more money than what this target number says. So if the target number on this is $6,480 per year, your goal should be to put in $7,000, $8,000, $10,000, $12,000, everything in excess of this target. is really helping boost and grow the cash value significantly. If you are not meeting target or you're putting in less than the target number, 5,000, 4,000, we would call that an under targeted policy, right? Meaning that you have less money going towards cash value, you have more money going towards the cost of the policy. And just so that you guys know, if you're an agent, this is also the number that the agent will get paid off of. So this is also how you can tell if your policy was written for you to grow cash value, or if your policy was written for your agent to earn a nice big commission. Because if you increase that death benefit, this target number will go up. If you decrease that death benefit, this target number will go down. I'll kind of show you that. I'll manipulate it for you. And then right here, max non-MEC premium, or what some companies will call the 7-pay max non-MEC premium, $31,000 basically dollars a year. That is essentially the maximum amount of money that you could contribute per year in the first 4 to 5 years. Bring this closer to you guys, depending on your age. So as you get older, you really need less life insurance than when you're younger to put the same amount of money in. So while this guy's only 40, and to be 40 and put in $30,000 a year, he needs a $500,000 death benefit. If he was 50, he could probably get away with maybe $300,000, $300,000 death benefit to be able to put in $30,000 a year. So the older you are, the less life insurance you need to put in the same amount of money. And then again, this is the most amount that you can put in the first 4 to 5 years. After that, this number will get reduced down here to the guideline level premium, $24,860 a year. So the guideline level is your maximum amount that you can put in through all years of the policy. Every year. That's the max that you can contribute per year. And then your guideline single, that's essentially, I mean, to make it easy math, right? That's essentially the amount of money that this insurance company would need to collect from you to say that this policy is basically paid up. But in IUL policies, you can't put that all in 1 year. That would have to be spread out over a 5 to 7 year period. So I'm going to show you guys like how these numbers change as we manipulate that death benefit. So let me go here into funding. And literally, as I change this, let's say that he doesn't want to get a $250,000 death benefit. He wants he doesn't want a $500,000 death benefit. He wants a $250,000 death benefit. What you're going to see is all of these numbers just got adjusted. So minimum premium went down. Target premium went down, guideline level, all of them, right? Every single one went down. So what you really want to be thinking about here is, what's this client's goal? Like I always tell my client, if the goal is to grow cash value, how quickly do we need access to that cash? If we're looking for cash like right away, like year 1, year 2, this client would want to be putting in really close to this max non-MEC premium number per year. That is what's going to give you access to cash the quickest. If they can't reach this number, like let me go back to the $500,000 death benefit just to give you guys kind of a little run through here. If we put this back at $500,000, that's going to update all these numbers for us in real time. Check it out. So if we go back to this $500,000 death benefit, he can put in $31,000 a year. Well, maybe he doesn't want to put in $31,000 a year. If we look over here at our premiums, maybe he wants to do $2,000 a month, which is $24,000 a year, but he still wants access to quick cash right away. If we look at the illustration here, what you're going to see is he's putting in, right, $2,000 a month, or essentially $24,000 a year. But if we look over here, walk you guys through this a little bit. Accumulated value is how much plug for my church, Echo Church. Check them out. Great church. At Echo Church Live on Instagram. And they're also on YouTube. But to not distract myself, the accumulated value is how much money you have inside your policy. The surrender value is how much you have access to. So with this insurance company, there's a handful of different insurance companies that do these. I like to work with insurance companies that have a 10-year surrender period. So think of that 10 years almost like a vesting schedule. Like you don't have access to your full accumulated value for 10 years because the money's got to vest, right? So they'll give you access to some of it, but as the years go on, they give you access to a higher and higher percentage of it. But if this client's goal is to get access to money in year 1, he only has access to about half of what he put in year 1 because he did not contribute that $31,000 a year. He contributed the guideline level, 24,000 a year, but not the 31,000. So if we go back here and we update this a little bit, let's say instead of doing, I don't know, 2,000 a month, let's say he wants to do 2,500 a month. And then now we look at this. Let's see where we get. Dun, 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 dun. So he's putting in now close, right? Really close, 30,000 a year. Put in 27, now he has access to 17. It's a higher percentage. So if you're maximizing the account in the first year, year one, you should have access to roughly about 60-ish% of what you put in surrender value. Why would you want to access this, right? Maybe you want to take out some money to go finance a project, maybe buy some real estate, maybe expand your business, right? There could be any number of reasons why you would need access to this. That's not the whole point of this call. But just showing you how you can manipulate the numbers to get it to do what you want. And also how you know if you're getting taken for commission, right? Because easily we could keep this policy at $500,000. I could get paid a percentage of $6,480 for helping a client with this. But if my client only wanted to put in $2,000 a month, not $2,500 a month, and he wanted that $2,000 a month to be the max, then this is not the right policy for him. This doesn't make sense. What would actually make sense is doing a lower death benefit. So if I drop this back down to $2,000, I bet we could probably get away with maybe a $350,000 death benefit. Let's see. Pretty close. We need a little more, so maybe we go 400,000. Let's do 400,000. With a $400,000 death benefit. Yeah, spot on, right? $400,000 death benefit, $24,800 a year is what he can put in. So this would essentially be pretty perfect for at least the first couple years, because if we go and look at the illustration now you're able to see he's able to do 24,000 a year, but not in all years, right? Because remember, the guideline level is always less. So he can do his 24,000 in the first couple years, but then it's going to get reduced down to 19,900. And you always get a weird year 5 and 6 because there's a certain amount of money that you can't exceed in the first 6 years, but then it starts to get normal in year 7. But take a look. He puts in 21,000, he has access to 13, compared to if we keep the death benefit at $500,000, it's going to be less because more money is going to go towards the cost of the policy. Less money will go towards the cash value. So if we take a look now it's 11. Not a huge difference, right? But there is a difference there. So these are things that you really want to pay attention to, like when you're looking at your IUL, like what are we looking for, right? Like is our goal, and show back to me, but is our goal like immediate access to cash? Is it tax-free retirement where you're trying to structure this where you have access to more money in the future? I'll show you that. I did that here too. All those things matter. The key is you want to pay attention to all these numbers that are on the left-hand side that I keep showing you, and they're all controlled by that death benefit. So your agent hopefully is explaining this to you. If not, I'll kind of show you this too. Like if we did this, if somebody that's 24 years old actually did this, 24 years old, good Lord, 40 years old actually did this, put in $2,000 a month. If they did this until 65 when they would retire, it's estimated that they could start taking out about $102,000 every single year in income until pretty much they're 90. So if we look at that, would have essentially had this sucker grow to over 5.6 million. If they died, their family would still get access to 1.157 million, and they would have taken out, what is this? About 2.5 million, 100 grand for 25 years, about 2.5 million bucks. So it just shows you the different ways you can use it. But if we go back and we change this death benefit, right, and this is again with the $500,000 death benefit, so that's good. Let's take a look at this. With the $500,000 death benefit, he's not fully maxing it out in the first couple years. Like he's maxing it out the guideline level, but not in the very beginning. 102,000 a year. But if we go back and we change this, let's change this to a $400,000 death benefit. Let's see if you guys don't notice, I make a lot of sound effects. So the premium is going to look a little weird, right? Because again, we are working with that guideline level, right? He can't go over that number. So it's going to reduce it just because of the fact that he simply can't put in 24,000 a year. So these are things that you want to be mindful of, right? Like what's the most that he could see himself putting in every year over the next however many years? So if we go back to the $500,000, let's bump that back up. So let's just say that he does in fact want to do $2,000 a month. And let's take another look at it. If he does in fact want to do $2,000 a month for the next 25 years until he retires, that would again give him $102,000 a year in income in retirement, estimated, right? Estimated income, we're only looking at like a 6.5% rate of return. These things average a lot higher than that. But let's say that he doesn't end up putting in $2,000 a month. Let's say that he ends up putting in only $1,000 a month, but he still has that $500,000 death benefit. Well, let's take a look. What's going to happen? Only puts in $1,000 a month. Now, instead of getting out $102,000 a year, he's getting out $21,000 a year. That is a drastic difference. Say wow. Wow, right? Hold on. Say wow. Wow. It's crazy, right? When you think about that, this just shows. So when you guys hear people say like life insurance is so expensive, it's not that it's expensive. It just needs to be funded correctly. If you're not funding it correctly, it's going to look ridiculously expensive. You put in $1,000 a month to walk with barely $2,000 a month in retirement. That's only that's what that doubled in 25 years. That's not good, right? That's not good. But if you wanted to do this, only $1,000 a month, then what again we would do is we would come in here and we would cut the death benefit. We would drop this down to $250,000, what we call face amount if you're just joining. And boom. So now we're looking at guideline level is at $12,000, right? So $1,000 a month, $12,000 a year. Now, instead of getting $21,000 a year, he's able to get $46,000 a year just because I lowered the insurance. I didn't change anything, right? Still doing $1,000 a month, but because I lowered the insurance, I lowered his cost, he's able to get more money out of the policy. So again, these are just important things that I think you guys should know when you're looking at your plan. If there's any questions, I haven't seen any really get dropped in the chat. Again, for those of you in Canada, these are not available to you in Canada yet, but hopefully that is going to come. But these are something that I'm really passionate about, making sure that people understand how IULs work, because they're not complex. They're super, super easy products to understand. But if you don't understand what your goal is for that policy and what you want it to do, it's not going to work. It's not going to do what you want it to do, right? So I had somebody comment on a video yesterday. I'm going to put you guys, stand you up because you're probably rocking around. There you go. But I had somebody comment on a video yesterday like, ew, IULs are so expensive. And I responded, did you get a quote? Like, how do you know that? Did you get a quote? And he said, yes. And I said, okay, my best guess is either A, you're a lot older, B, you smoke, C, you have something in your medical history, D, this thing was not properly structured. That's what's going to make it look super expensive. If you guys design it correctly, you get the least amount of life insurance required for the most amount of money that you want to put in per year, your cost is going to be super low, and you're a decent age, a decent health, a non-smoker, no criminal history, all of that good stuff. These plans shouldn't cost more than 1% to 2% of what you put in over the course of your entire life. Right? You don't want to measure fees in just a 1 or a 2 year increment. You want to measure them against the course of your entire life. Way less than what you'll pay in any investment account. But again, you have to get approved at a good health rating, right? So those are all things that play a factor in it. So hopefully this helps. I know it was really technical, but it's something that I'm really passionate about. And this will be saved. So you guys are always welcome to come back here and revisit this video later. And I hope you got a lot of great, education and information out there about it, and share this with anyone else you can think of that's looking for IULs. Again, we are working with a male that was age 40, a preferred non-tobacco health rating, which just means healthy non-smoker. So yeah, I hope you guys got a lot, and I'm trying to do lives every single week. Next week, the goal is to have a guest. We didn't have a guest this week, but we're going to try to have a guest next week and keep it interesting for you. And hopefully I will see you guys next week back here live on YouTube. Catch you later.